In the spring of 2023, something strange happened on the stock market. A tiny trading account based in London suddenly predicted three major market moves, almost perfectly. The first prediction came hours before a sudden tech stock drop. The second came before a sharp market rally. The third predicted a massive sell-off that wiped billions from the market in a single afternoon. To professional traders, it looked impossible. The account didn't belong to a hedge fund. It didn't belong to an investment bank. It belonged to a 21-year-old university student named Daniel Hart. And according to financial forums online, Daniel had built something extraordinary, an algorithm that could predict human behavior in financial markets. But months later, Daniel would reveal something that shocked everyone watching his rise. The algorithm never existed. 2 years earlier, Daniel Hart was just another student walking through the gray streets of East London. He studied mathematics at a modest university. His life was predictable. Classes, late-night studying, cheap instant noodles for dinner. Daniel wasn't interested in parties or nightlife. Instead, he spent his evenings staring at charts. Not our charts. Stock market charts. The strange movements of financial markets fascinated him. Prices rose. Prices fell. Sometimes for logical reasons. Sometimes for reasons nobody could explain. And the more Daniel watched the market, the more he started to notice something unusual. Prices didn't just move because of numbers. They moved because of people. Fear, greed, panic, excitement. The market, Daniel realized, wasn't a machine. It was a massive emotional crowd. And crowds behave in patterns. At first, Daniel studied markets the way most beginners do. He watched YouTube tutorials, read trading books, followed financial influencers. But the advice always felt the same. Technical indicators, moving averages, complex algorithms. Yet when Daniel looked closely, he noticed something odd. Even professional traders often lost money. If the indicators were so powerful, why did so many experts fail? So Daniel stopped studying charts. Instead, he began studying people. He started reading financial forums, watching comment sections, analyzing headlines during market crashes. And slowly, a strange idea began forming in his mind. Markets didn't move based on logic. They moved based on mass psychology. When people felt confident, prices rose too fast. When people felt afraid, prices collapsed too hard. If Daniel could read the emotional state of the market, maybe he could predict its next move. Daniel opened a tiny trading account. Only a few £100, money he could afford to lose. His strategy was simple. He didn't use complicated formulas. He didn't use trading bots. Instead, he watched human behavior, news headlines, social media posts, financial panic. And one afternoon, Daniel noticed something interesting. Investors online were celebrating a tech stock that had been rising for weeks. Everyone believed it would keep climbing. But Daniel saw something else. Excitement had turned into overconfidence. He placed a small bet that the stock would fall. The next morning, the stock dropped sharply. Daniel made his first profit. It wasn't much, but it proved something important. The crowd wasn't always right. Over the next few months, Daniel refined his strategy. He watched emotional signals everywhere. Market optimism, sudden fear, media hype. Instead of chasing trends, he started predicting when those trends would break. At first, the wins were small. Then something unexpected happened. One evening, Daniel noticed something strange across financial media. Every headline was optimistic. Markets were climbing rapidly. Investors were celebrating a new bull market. But to Daniel, the mood felt too confident, too comfortable. He placed a large trade, predicting a market drop. The next day, markets fell sharply. His account doubled. A few weeks later, he made another prediction. This time, he bet the market would rebound after a crash. Again, he was right. Then came the third prediction, a sudden sell-off that caught many professional traders off guard. Daniel predicted it hours before it happened. After that third trade, his small account had grown into a small fortune, and people started noticing. Financial forums exploded with speculation. Who was Daniel Hart? How was he predicting these moves? Some believed he had created a revolutionary trading algorithm. Others believed something darker. Maybe he had inside information. Maybe he was manipulating the market. Some even accused him of running a secret trading group. Soon, Daniel's trades were being analyzed across the internet. Strangers tried copying his moves. Financial blogs began discussing his predictions. Then something even more serious happened. Market regulators started paying attention. From their perspective, the situation looked suspicious. A young student predicting major market movements repeatedly. It didn't seem normal. Emails arrived requesting explanations. Questions about his strategy. Questions about his technology. Daniel had become famous, but not in the way he expected. Finally, Daniel decided to explain his strategy publicly. Investors expected him to reveal an advanced algorithm. Some believed it involved artificial intelligence. Others believed it was a complex statistical model. Instead, Daniel told them something completely unexpected. There was no algorithm, no secret trading software, no advanced mathematics. Daniel's predictions came from something much simpler. He studied fear and greed. When people became too confident, he expected markets to fall. When people became too terrified, he expected markets to rise. His strategy wasn't technological. It was psychological. And suddenly, thousands of traders tried copying him. At first, the strategy seemed to work for others. People started trading based on crowd psychology. But something strange began happening. The more people copied Daniel's strategy, the less effective it became. Markets started behaving differently. Signals became weaker. Patterns disappeared. Why? Because markets evolve. Once enough people believe in a strategy, the strategy stops working. Daniel himself noticed this shift. Trades became harder. Predictions became uncertain. The crowd had adapted, and the advantage disappeared. Daniel Hart eventually stepped away from public trading. Not because he failed, but because he understood something deeper about markets. Markets are not machines. They are living systems shaped by millions of decisions. And while intelligence can help, understanding human psychology matters even more. The greatest investors in history didn't just study numbers. They studied people, fear, confidence, her behavior. Because in the end, markets aren't moved by logic. They're moved by human emotion. And sometimes, the person who understands a crowd best can outsmart the entire market.